Starting a business is exciting, but before you even think about sales, branding, or websites, there's a crucial decision. What kind of a legal structure should your business have? In the US, the most common options for solo or small business owners are sole proprietorship and limited liability companies, or better known as a LLC. Choosing the right structure can affect your taxes, liability, ability to raise money, and even your personal freedom. Make the wrong choice and you could be paying more taxes, exposing yourself to unnecessary risk, or limiting your growth potential. Let's start with the basics. A sole proprietorship is the simplest form of a business. It's just you, one person running the business. Legally, there's no distinction between you and your business. You report your income on your personal taxes and you're personally responsible for any debts or legal issues. An LLC, on the other hand, is a legal entity separate from you. It protects your personal assets, like your home or savings, from business liabilities. An LLC can have one owner or multiple owners and is flexible in how it's taxed and managed. Think of it this way: a sole proprietorship is like riding a bike. Simple, fast, but less protected. An LLC is like driving a car with airbags and seatbelts. Slightly more setup, but much safer for bigger risks. One of the main reasons people choose an LLC over a sole proprietorship is the liability protection. In a sole proprietorship, if your business faces lawsuits or owes money, your personal assets are at a risk. Creditors could go after your house, your car, and even your savings. An LLC creates a legal barrier. Business debts and legal actions generally stay with the company, protecting your personal finances. This becomes particularly important if you're in an industry with high risk, like consulting, construction, or selling products that could potentially cause injury. For very small, low-risk ventures like freelance writing, digital products, or consulting with minimal exposure, a sole proprietorship might be sufficient, but as your business grows, the protection an LLC offers becomes much more valuable. You report profits and losses on your personal tax return. There's no separate business tax, which keeps things straightforward, but you are subject to self-employment taxes on all profits, which can add up. An LLC is more flexible. By default, a single-member LLC is taxed like a sole proprietorship, but you can also choose S Corp or C Corp taxation. This can reduce self-employment taxes and offer more tax planning options as your income grows. For example, if your business starts making over $100,000 per year, being taxed as an S Corp can save you thousands compared to a sole proprietorship, while still keeping your business flexible. Sole proprietorships are cheap and easy. Often, no registration is required beyond local permits. You don't need a separate bank account, though it's sometimes recommended, and the paperwork is minimal. LLCs cost more. You'll pay state filing fees, which may vary, and some states have annual reports or franchise taxes. You also want a separate business bank account and possibly a registered agent. However, think of it as insurance for your business and personal assets. The extra effort upfront can save you from massive headaches later, especially as your business grows. Another factor, perception. An LLC can look more professional to clients, investors, or partners. For example, a freelance consultant might be fine as a sole proprietor for small gigs, but if you're pitching large contracts, working with corporate clients, or seeking investors, having an LLC can signal stability and credibility. Sole proprietorships can feel casual, perfectly fine for small-scale or hobby businesses, but they may not inspire the same confidence when trying to scale. Sole proprietorships are limited in a structure. You're personally liable and raising capital is harder. You can't sell shares or bring in investors easily. An LLC allows multiple owners, partnerships, and easier capital raising. You can also structure profit distribution in flexible ways. For example, a small e-commerce brand might start as a sole proprietorship But when sales hit 50 to 100,000 per year, moving to an LLC gives protection and makes it easier to hire employees, raise funds, or partner with others. Here's a simple rule of thumb. If your business is low risk, small scale, and simple, start as a sole proprietorship. You can focus on growth without overcomplicating taxes or paperwork. If your business has higher risk, plans to grow, or will need outside funding, start as an LLC. It protects your personal assets, gives flexibility for taxes, and adds credibility. Remember, you can always start small and upgrade to an LLC later. But starting an LLC early can prevent legal and tax headaches if your business grows quickly. Some practical advice: always separate personal and business finances, even as a sole proprietor. This makes taxes and accounting easier. Consider insurance. Liability insurance can protect you regardless of structure. Think about long-term goals. Do you plan to hire employees, seek investment, or expand internationally? These goals often favor an LLC from the start. Use professional help if needed. A small consultation with a lawyer or accountant can save a lot of money and mistakes later. The choice between a sole proprietorship and a LLC comes down to risk, growth potential, and complexity. Sole proprietorships are simple, flexible, and fast to start. LLCs offer protection, credibility, and options for scaling. In 2026, small businesses that combine agility with smart planning will thrive. Choose the structure that protects your assets, supports your goals, and grows with you, because the foundation you lay today shapes your success tomorrow.